What if I told you that the most critical decision for real estate investing is not the property that you're buying, but the mortgage that you're setting up on that property and how you set up your capital structure? Sounds bold, right? But here's what I see. Many real estate investors focus 90% of their time and energy on finding a great deal and picking an investment strategy. They treat mortgage financing as a last step and as a commodity where it's about finding the lowest rate and signing the paperwork. This is where the most painful mistakes happen. I have seen real estate investors with great deals at hand, with properties with great potential, unfortunately experience losses. Why? Because these real estate investors did not think about the mortgage as the strategic tool that it is. They just thought about it as a loan rather than as a lever. And when you pick the wrong tool, that will derail your master plan. The wrong mortgage can trap your capital when you need it for your next deal. It may have terms that block your refinance when you need it the most, or it can have costs within its terms that will cost you thousands and eat into your profits. Suddenly, that great rate becomes the most expensive part of your investment. This video is not just about getting you mortgage approved or mortgage ready. It's about helping you become strategic when it comes to financing your investment properties and aligning your financing from day one with your chosen investment strategy, which will significantly increase your chances of success and will get you to the results that you envision. We are going to dissect 11 of the most essential Canadian real estate investment strategies. We're going to align financing with each strategy so that you can mitigate risk, maximize flexibility, and at the end of the day, scale your portfolio and avoid the costly mistakes. Getting this right is the secret weapon for every seasoned real estate investor. And in today's video, I am sharing the playbook with you. So if a mortgage is a strategic tool, let's take a look at what's inside that toolbox. Here in Canada, the financing options fall into 3 tiers. Think about that as your flexibility spectrum. These tiers are the A lenders tier, the B lenders tier, and the C lenders tier. So let's talk about each of those. In the A lenders tier, we're referring to the banks, the credit unions, and what's referred to as monoline lenders. Monoline lenders are lenders that only offer mortgages. In this group, you're going to get the best mortgage rates on the street, but you're going to deal with much tougher mortgage qualification guidelines. This is the group to maximize on as far as you can, and it's a good group to go to if you are reporting sufficient income on your personal tax returns and also if you've got excellent liquid. The second group is the B lenders group, and it's referred to as well as alternative lenders or trust companies. This is the group of lenders that are willing to do certain things that the first group is not willing to work with. For example, they have great programs to work with self-employed clients who may not necessarily be paying themselves a lot from their business on the personal side. They also work with lower credit scores. They work with bank statements, and they also use a higher percentage of the rental income for your rental portfolio. But for that, they're going to charge you higher interests and also what's called lender fees. Their interest rates are generally 1 to 1.5% higher than the first group. Lastly, the third group, which is the C tier or the private lenders. This includes mortgage investment corporations. It also includes private individuals or private corporations who want to lend private money. This group is fast, moves fast. They can help you pick up deals on a short notice. Their closing cycles are shorter. They are also lighter on paperwork, and they care mainly about the property that you are buying or the property that you own, that you're seeking a mortgage on. Obviously, they charge higher interest rates and higher fees, but they are best for flips, for bridge loans, or for construction financing. Okay, A, B, and private. You got it? Let's put these tools into work. All right, let's dive into the real estate investment strategies for building long-term wealth. For each of these strategies, I'm going to share with you the goal of the strategy. We will also talk about the common financing mistakes that derail the success of the investor who is using that strategy. And I will share with you the strategic financing solutions and pro tips.